Good morning, everybody. This is Dan Hollander with Hollander Loan and Max Bauer. It is Thursday, the 23rd of June, and I'm here to address some concerns that have been raised having to do with the market that we're in, which we can now characterize as a bear market. A bear market means that the market has gone down by at least 20%. That was true of NASDAQ a few weeks ago. It became true more recently of the Dow Jones Industrial and S&P 500. And so we have touched bear market. What is that? Well, if we have a correction, the market goes down 10%. If you have a bear market, it goes down 20%. And there's the concern then of, will we be going into recession? Well, we can now address the question that has been voiced multiple times. Yes, but is this time different? People are very anxious about the fact that there could be some unique properties to where we are at in this bear market. First, let's say that the economy is actually not in a bad position and the banks are flush, so we're not going to have the kind of contractions that we had in 2008 where it was a strangle. There was a strangling of our credit, and so that means that we will still have the ability, the liquidity to be able to help corporations and companies that are startups grow. That bodes well for the economy. So there's no systemic risk that we see. So what do we see? Why are we in a bear market? Where will it go from here? Well, before answering that question, let's frame the conversation in terms of a time. If we have a market correction that's 10% and we have a bear market that's 20% down, we should try to understand, well, what kind of impact do they typically take? And from a temporal point of view, a market correction normally is a garden variety over 3 to 6 months. If we look at a bear market can last from 6 months to 18 months, generally speaking. And then if you do have a recession, if we sink into a recession, and we'll talk about that briefly, it could last from 18 months to 3 years. That's not forever. That's why we have strategies in place to diversify our portfolios. That's why we have an asset category that includes cash, because cash is king when these prices are going down. And that is why we ask to be able to focus our efforts on those areas that have shown weakness and created opportunities. So there's a real opportunity cost that will be paid if you sell off your portfolios and run for the front doors out of fear. So our job is to be able to put things in a context that you can understand and allow us to do our job. It's difficult. It causes stress. We understand that. At the same time, people are facing pressures of inflation with increased costs and the fear of losing other monies. We understand that. Our job is to help you create the most completely informed context so you can make decisions and work with us to have your money take advantage of lower pricing and look forward to getting through whatever we will be faced with in terms of your retirement funds and non-qualified assets that are growing, but have since the beginning of the year, taking a hit. So much so that even bond portfolios, because interest rates are rising, are underwater by the tune of 11.8%, as cited by the aggregate bond index. So no one's safe right now, but we will navigate this carefully with you, and I want you to feel free to call any of us at Hollander Loan and Max Bauer and allow us to field your questions. Hope you have a great weekend. Thanks.